I started studying economics at university and ultimately got a job at the Reserve Bank because I had a really good economics teacher at high school. You know, it wasn't a top 20% high school or possibly even top 80% high school, but the teacher was enthusiastic and passionate and really instilled that passion and enthusiasm in me. So it's very important work that you'll do, as you know. So inflation. Start talking about how we measure inflation in Australia. The Australian Bureau of Statistics provides data on a quarterly and monthly basis now for inflation. So this is measuring how prices of things that households buy are changing. It's both goods and services. We focus on the change in prices, that is the rate of inflation, more so than the price level. And we look at inflation on a monthly, quarterly, and a year-ended basis. So, for example, in the next 2 weeks, at the end of July, just before the board meeting, we'll receive inflation data for the June quarter, and we'll be looking at year-ended June quarter inflation. That is the average change in prices from June quarter last year to June quarter this year. But for a more timely estimate, we'll also be looking at the pace of quarterly inflation in the June quarter. So that is the price changes between March quarter this year and the June quarter. And obviously our target, as you will know, is 2 to 3%, and that's in year-ended terms for headline inflation. The definition of inflation is prices of things that households spend money on, goods and services, not transactions between businesses. It also excludes investments that households would make in, the share market, and it does measure the cost of housing in a sense, but it doesn't include house prices per se. So it excludes the value of land. I'll talk a little bit more about that in a moment. This is how the ABS classifies the different parts of the consumer price basket. So there's many goods and services that are included in the CPI. Usually there's about 90 components, which we call expenditure classes. I think at the moment there's 87. And these are the groups of expenditure classes that the ABS focuses on when they report their data. So as you can see, there's a range of different categories. And at the RBA, for our internal analysis, which is also feeding into the data that we publish in our reports, we tend to focus on a slightly different set of groupings, which are consistent, but more classified into the types of categories that we think share common determinants. So just to give you an example, there would be services within education and services within food, like, restaurants and meals out and takeaway. And we would categorize them into market services because there's a high labor component and we think that they have a common determinant. So that makes it easier for our analysis. So I'll talk a little bit more about each of those 4 groupings on the right in a little bit more detail soon. But first, I'll talk a bit about what inflation in Australia looks like at the moment. So we look at measures of headline inflation and we look at various measures of underlying inflation. The target that we're aiming for is headline inflation of 2 to 3% in year-ended terms. And we spend a lot of time thinking about headline inflation because it's our target, and we also spend a lot of time thinking about measures of underlying inflation because they provide a more accurate gauge of the current inflationary pressures at the moment. So whereas headline inflation would be thrown about by policy changes or the price of bananas going up from $2 a kilo to $12 a kilo like it did in the mid-2000s, underlying inflation measures such as this try to strip through that and help us get a better sense of the current pulse of inflation. So this graph, as you can see, shows 2 measures of inflation, year-ended and quarterly. So if we were aiming for 2 to 3% inflation, you would want the year-ended line to be around 2.5%. And the quarterly percent change consistent with that on average would be about 0.6%. And as you can see, Unfortunately, inflation's quite a bit higher than that at the moment. So you can see the inflation targeting period began in 1993, and since then, inflation has been pretty close to the target range of 2 to 3%. But obviously, it's been above that since the pandemic, or since just after the pandemic started. Inflation started increasing quite rapidly and has come down since then, but still hasn't come down far enough. This hasn't just been an Australian problem. Inflation has been a global problem in the past few years. This graph shows a few of our major advanced economy peers, so the United States, Europe, UK, and Canada. And here we've split the measure of consumer price inflation into goods and services. And this is quite a common way to present the data at central banks, is to see how much different components are contributing to overall inflation. And I'll talk a bit more about that in Australian case as well. But as you can see, it was both goods and services price inflation that picked up during the latter half of the pandemic. And since then, goods price inflation has slowed, and services price inflation has stayed reasonably high. For the Australian case, I'll show a similar decomposition. We tend to look at the data in Australia, as you can imagine, in quite a lot of detail. So it's slightly more detailed than this, but just a few extra categories. So we have market services, housing, administered prices, and goods, consistent with the slide I showed a few minutes ago. And as you can see in Australia, just like overseas, it really was a broad-based increase in the pace of inflation. So it wasn't just, goods or some services, it was quite across the board. And just like overseas, the pace of goods price inflation, so that's the darker blue bars, have started to slow in the past year or so. And I think this graph nicely shows what are the parts of the basket that are holding up inflation recently. And so market services inflation still reasonably high, also housing and administered prices as well. So I'll just dig into these categories a little bit more. I think this next graph Sarah might have spoken to you about earlier this morning. It's market services price inflation, which makes up about 20% of the CPI. So these are the types of services that households spend money on that aren't goods. So you'd be thinking about insurance, meals out, takeaway, the hairdresser, nail salons, that sort of thing. And this is a category of the price basket that we tend to think as most closely reflecting conditions in the labour market. So when the labour market is tight, as I'm sure Alex would have spoken to you about the tightness in the labour market earlier today, we have unemployment is low relative to full employment. And so when there's strong demand for labour relative to supply, it pushes up wages. And the services where the labour component is a large share of the cost base or a large share of the price, that increase in wages tends to lead to higher inflation, especially showing up in these sorts of components like market services. So in the most recent episode, it hasn't just been labour costs that have been increasing, contributing to this. It's actually been reasonably broad-based inflation. As I showed in the earlier graph, really the price of most things were increasing, including services like insurance that are unrelated to labour costs. But it is still the case that labour costs are playing an important part in the increase and the ongoing high level of market services inflation. So when we're thinking about the causes of inflation and we're talking about labour costs, we're not so much talking about wages, but in particular, we're talking about a special measure of labour costs that takes into account productivity, and we call those unit labour costs. Some people refer to it as ULCs in the building, but unit labour costs are the labour cost of delivering one unit of output. And so the labour cost of producing one unit of output depends on how much firms are paying staff, but also how much the staff are producing within their working time. So on the next slide, I'll show a graph and a formula. So growth in unit labour costs, which is shown in the top panel, is approximately equal to wages growth less productivity growth. So if wages increase more quickly than productivity, then the cost to the firm of producing each unit of output is also increasing, meaning that firms feel pressure to increase their prices to maintain a stable profit margin. So for example, if wages increase by 5% and productivity is unchanged, so productivity growth is 0, then the labour cost per unit of output would also be increasing by 5%. And the effect of that on prices would be greater when the labour share of their cost base is greater, as it would be in market services in general. So that's the formula and that's the idea. As I said, the top panel shows year-ended growth in unit labour costs, and then the bottom panel shows the two contributors. So it's interestingly not just labour costs per hour recently that have been high, but also in the blue line you can see productivity or output per hour work has been low, or growth has actually been negative recently. And so it's that wedge between the red and the blue line that's represented in the orange, which is why unit labour costs are growing so quickly in Australia. So next I'll talk a little bit about housing. There's two main parts of housing that we focus on and that are in the ABS basket. These housing, or at least these two components, are about 15% together of the CPI, so quite important. And as you can see, they do tend to be reasonably smooth over time, so we'd say they're quite persistent. And items within the CPI can be persistent either because the prices don't change very often, or because the influences or the determinants of those prices can be persistent themselves. And so rent inflation is quite persistent because underlying supply and demand pressures in the rental market probably quite persistent over time, but also because rental prices don't necessarily change particularly often. As you can see, rent inflation is very high recently. New dwelling inflation was very high during the pandemic and has slowed, but is still quite high relative to average. So the new dwellings inflation is possibly a bit of a strange one that most of the public wouldn't be thinking about on a daily basis. What this is trying to capture is the cost of constructing a new house or a new apartment. Up until about 5 to 10 years ago, it was just the cost of constructing a house, but it does include the higher density dwellings now. But the important thing to remember with this component of inflation, new dwellings cost inflation, is that it really is just the construction cost. So it doesn't measure the price of land, for example. And often when people talk about, cost of living pressures, I'm sure they would have in their mind that it's housing is very expensive in Australia, and that's partly because the price of land has increased, and that's not what measured here. The other component of housing costs that people might have in mind when they think about cost of living pressures is their mortgage payments. That's also excluded from the CPI. And there's good reasons for that, including because if inflation was measuring interest rates and we use interest rates to try to control inflation, it would make things quite difficult if an increase in interest rates contributed to higher inflation. So new dwellings inflation, as I said, is the cost of constructing a house. That represents the cost for owner-occupiers or people that are going to own their home. Interestingly, well, I don't know if it's interesting or not, but I find it interesting in many countries, the cost in the CPI for owner-occupiers is actually like an imputed rent series. So the statistical agency will measure the cost of owner-occupied housing as what rent the person would be paying if they were renting a house. So Australia is a little bit of an outlier in that sense, not unique, but slightly different from most OECD countries. So how do we think about rent price inflation? The graph on the left shows one of the major determinants of the growth in rents, which is the vacancy rate. So you can see the green line, it's a share of vacant dwellings, and this is on an inverted scale. So as the green line increases towards the top of the graph, it's actually getting closer to zero. And so when the vacancy rate gets lower, rent price inflation tends to increase. And that's explains some of the dynamics recently with the increase in rent price inflation. On the right-hand side, and I think Sarah might have showed you a graph like this earlier today, but this is just advertised rents and the CPI rents by different cities. So you can see how things are tracking in each of the cities. And as Sarah may have mentioned, the advertised rents series, which isn't an official part of inflation, but we tend to look at it quite closely because it does provide us a good read on where CPI inflation is heading. And that's how we spend a fair bit of our time in my team, is looking at indicators such as these, because we really need to know where inflation is heading in a particular quarter and over the next couple of years so that we can provide the best advice to the board. The next slide digs a little bit deeper into new dwellings inflation. So that's the orange series in the top panel, which is the pace of new dwelling inflation that I mentioned earlier. And the blue series here is the growth in building commencements. So that's, the beginning of a new house or an apartment and the growth in that. Interestingly, I think before the pandemic, there was a reasonably close relationship between growth in commencements and growth in new dwelling inflation. So, we would look at that sort of measure to try and get a sense of where new dwelling inflation was heading in the quarter and over the next few quarters. But as you can see, as with many economic relationships, that relationship broke down during the pandemic. Commencements started slowing and inflation picked up. And as you can see, the pickup in inflation was consistent with the strong growth in the cost of building materials. And you might remember, during the pandemic, all of the stories about supply chain disruptions and the difficulty in finding building materials and everything else, which is playing a large part in the growth in new dwelling inflation. And so that is a pretty high share new dwelling inflation of the CPI basket. I think it's currently about 8 or 9%. And so when that's growing at an above average pace, it really does have a strong effect on inflation. The next category is administered price inflation. And so these are the prices of goods and services that are either set by the government or partly set by the government or heavily influenced by government regulations. So you can see utilities, electricity, and gas primarily, and then the other administered prices I've split out into the right-hand side graph as well. In a sense, these can be somewhat easier to predict for us because sometimes we do have a sense of how government policies are affecting price inflation. But there's a lot of other determinants beyond government policies, and you can see as well that these components of inflation have been quite high recently, and in some, such as tertiary education and state and local government, a little bit above average as well. The last category that I will talk about is goods price inflation. And I think there's some interesting snippets within here. So we've split goods into consumer durables and groceries. So consumer durables are, the sorts of things that you might buy outside of a supermarket. So TVs, computers, cars, that sort of thing. And groceries obviously being the food price inflation. Groceries price inflation does look quite high in year-ended terms. But if you look at the green quarterly bars, you'll see that it has slowed quite a bit recently. And so if the quarterly bars stay low for another couple of quarters, then the year-ended line would come down to be quite a bit closer or even below its average pace. And consumer durables price inflation in the top panel has also come down quite a bit from its highs during the pandemic. When we think about consumer durables, we tend to think a fair bit about the exchange rate and what's happening with global inflation and the price of imported goods. So I'll break that down on the next slide. This one's a little bit involved, but I think interesting and tells quite a powerful story, so worth talking through it. So in the top panel, we have the prices of imports of consumer durables. So again, this isn't an official, it is an ABS series, but it's not part of the consumer pricing basket. This is just the price of imports that are measured. And the pink line shows the percent change in the exchange rate. So when the pink line is positive, the Australian dollar has depreciated, and that means it becomes more expensive to buy foreign goods. And as you can see, there is quite a close relationship in the top panel. So the exchange rate depreciates, import price inflation tends to increase. And notice the scales are the same in the top panel. So on average, just by looking at this graph, you might think that, you know, a 10% depreciation is associated with a 10% increase in import prices. And then on the bottom panel, we have what we call second stage pass-through of the exchange rate. So the first stage of the exchange rate pass-through is that a change in the price of the Australian dollar flows through to a change in the price of imports. And then the second stage of pass-through is that the change in the price of imports flows through to a change in the price of goods, consumer durables that households spend their money on. So as you can see, if you look at the left-hand axis and right-hand axis on the bottom panel, I have changed the scales a little bit. And that's because changes in the price of imports are associated with much smaller changes in the price of that households pay for consumer durables. And that's because it's partly because not all consumer durables are imported, but also because the price of the product itself that the business pays for isn't the full input cost that they're passing on to the consumer. So the business that is selling to the consumer also has other costs, such as the rent that they're paying for the store, the electricity to keep the lights on, the wages that they're paying to the staff in the store, and that sort of thing. So again, there used to be quite a nice relationship before the pandemic, and there is still a relationship in the sense that import prices affect consumer durables prices. But again, you can see that the relationship broke down during the pandemic, whereby consumer durables prices increased quite a lot and inflation was very high relative to import prices. And this aligns with the overall general cost pressures and supply disruptions that I mentioned earlier. So I'd like to just spend a little bit of time talking about underlying inflation, which I mentioned before. As I said, Australia's and the Reserve Bank's inflation target is 2 to 3% for headline inflation, and we think a fair bit about underlying inflation, and that's because we want to try and abstract from volatility in prices that aren't really reflecting the general inflationary impulse in the economy. And one example of a volatile price is the price of fuel that we put into our motor vehicles. So this is a weekly series showing cents per litre, and the blue line is weekly, and the orange we've drawn a line to try and see what the quarterly average is, because the quarterly pace of inflation that the ABS reports is the average throughout the quarter relative to the average throughout the previous quarter. And as you can see, fuel obviously increased quite a bit through the pandemic. But if you look at the most recent few bars, I can talk through how this flows through to trim mean inflation, and how trim mean inflation, as one of our preferred measures of underlying inflation, tries to place less weight on these sorts of changes. So the last orange line is the June quarter, which we haven't received the official data for yet. The one before that is the March quarter. And so you can see that there was a price decline in the March quarter relative to the December quarter of the price of fuel. And that price decline was about 1%. And so the next graph shows the distribution of price changes in the CPI basket, and helps to explain how the trimmed mean rate of inflation works. So each one of these bars is an expenditure class, and the height of the bar represents the pace of inflation in the quarter. So you can see fuel, I've highlighted in red, was about a 1% decline. And the width of the bar represents the weight within the basket. So that red fuel bar is about 4% of the width of the overall graph, a little bit less than 4%. And that's because fuel has a weight of a little bit less than 4% in the CPI basket. So what we do when we calculate the trim mean, or what the ABS does these days to calculate the trim mean, is we can rank all of the inflation rates in the quarter from smallest to largest, smallest generally being negative ones. And then to calculate the trimmed mean, it's a 70% trimmed mean, so we're excluding the bottom 15% and the top 15%, and those are the yellow shaded areas on this graph. As you can see, the red bar has fallen into the bottom part of the distribution, outside of the trim, which means it's not going to directly affect the rate of trim mean inflation, because the rate of trim mean inflation is the mean rate of inflation of all of the expenditure class inflation rates that are within that trimmed distribution. So it's just the average of all of those inflation rates in between the two yellow columns. And so I just present this as an example to show that, when there is volatility, either in fuel or some other component of the CPI basket, that this is how a trim mean works to try and extract from those prices. So in the March quarter, which is what this is showing, fuel was outside of the trim, and fuel tends to be outside of the trim on average, but could be within the distribution. Some quarters, fruit and vegetables tend to be outside of the trim. But also if there's a government policy that causes a large price change, that would also cause the affected inflation rates to be either above or below the trimmed distribution. I'm just going to talk a little bit about inflation expectations before showing the previous forecast. Inflation expectations, extremely important for a central bank, and expectations of inflation, we think, tend to have a pretty strong effect on the actual rate of inflation itself as well. So if a business expects inflation to be high, they're more likely to raise their price. If a worker expects inflation to be high, they're more likely to ask for a larger wage increase, understandably. And so we track many different measures of inflation expectations quite closely. These are measures of longer term inflation expectations, so generally over the next 5 to 10 years or so. But we'd also track measures that, ask households, for example, about expected inflation over the next year or next 1 to 2 years. There's a fair bit going on in this graph, but the pink and yellow lines are both survey measures of what economists think inflation will be over the next 5 to 10 years. And the blue and green lines are inferred measures of expected inflation from financial markets. So there's financial instruments for which the return to the investor depends on the rate of inflation that's realized. And since the return depends on the actual rate of inflation that's going to be realized, it's possible to estimate the implied rate of expected inflation from the prices of those financial securities. And as you can see, some of these measures of expectation for inflation have been trending up a little bit recently, but the ones that have been trending up were also quite low relative to the inflation target before the pandemic. And so finally, I'll just show our forecasts for underlying inflation back from the May Statement on Monetary Policy. And so we're right in the midst of updating this at the moment. But this is where we were looking at the time of May, and we were forecasting a return of underlying inflation to within the target range. And the blue fans are sort of confidence intervals, which try to give you a sense of the likelihood of inflation falling within those bands at different horizons. As you can see, they are quite wide, so they're constructed based on previous forecast errors of the Reserve Bank. And these sorts of forecast bands are quite commonly used in other central banks, and it's quite common for them to be fairly wide. It's not a challenge just faced by the RBA, but inflation is notoriously difficult to forecast, even over the next 2.5 years or so. So that's where I think I'll leave it, but I'm sure you have many questions, and I'm looking forward to hearing them.